This thing's a big mess. It's like the big house of cards that's set to come down. We're into it right now. It's not tomorrow. It's not maybe. It's right now. This is a global crash. The American empire is going down. We don't know what it is anymore. Whatever is money today, but there's a lot of rumor about the Fed coin and CBDC, Central Bank Digital Currency. There's also Bitcoin and now Fed. So the question is, what is money and what does it mean? And anytime there's a big change, there's always the rumor goes up and speculation and panic and all this. And it's for good reason. Throughout history, who controls the money controls the world. And since 1944, America has controlled the money, with the US dollar being the reserve currency of the world, which caused America to boom, but it also caused many problems. And when we lose our reserve currency status, which started in 1944, people were just blown away with the inversion of yield curves because yield curves are like reading the tea leaves. You can tell what's coming next. So our guest today is George Gammon. What does it mean to the average mom and pop out there? What's going to happen?
Well, I think the first thing people need to realize, just going back to what you were saying about Bretton Woods, the United States was then in control of the money. To a certain degree, that's true. But now I would argue it's more so the banks. The banks control the money, and more specifically, the banks outside of the United States.
That's Jeff Snyder. It's called the euro dollar and the euro yen and the euro peso and the shadow banking system. He calls them the banksters.
That's a good term, but the reason I start with that is so people realize that 95% of the dollars in the world were created by lending them into existence. So most people have this idea that dollars are just kind of a green piece of paper, and you take your green pieces of paper that you digitally get with your paycheck and deposit it at the bank, and then the bank kind of puts that in a vault and stores it for you until you need it. But what they need to understand is 95% of those dollars were not green pieces of paper. They were lent into existence by a bank extending credit. And therefore, those dollars are a liability of a bank. If your listeners have an account with Wells Fargo or Chase, B of A, something like that, and what the depositors found out very quickly with Silicon Valley Bank is that those dollars, which they considered assets, you got $100,000 in your account, that's your asset, but that was a liability of a bank. They weren't putting it in a vault. They were actually taking your money and they were lending it out, and you just had to trust that that bank was going to pay you back. The thing people should really be worried about as far as a central bank digital currency isn't necessarily a competing currency to the dollar. It's not necessarily a Fed coin or, Janet Yellen coming out and saying, okay, now we're going to start using this CBDC. So whether you guys like it or not, we're just going to force you guys to use this and ban cash. But what a CBDC really is, when you look at the mechanics and the financial plumbing, it's just the individual taking their account that they now have with Wells Fargo, that's a liability of Wells Fargo, and simply moving it to the Federal Reserve. This is what we really need to push back against, assuming that you value freedom, liberty, free market capitalism, and especially your privacy. Because all those Orwellian things that we have heard of that we don't want to come to fruition, those cannot happen unless your dollars are on Fed's balance sheet, that your bank goes from being Wells Fargo to Jerome Powell and the FOMC. And fortunately, the good news is that is currently illegal for an individual in the real economy.
So you have $1 million or $100,000, that's your asset. But the moment you put it in the bank, it becomes the bank's liability. The banksters have to then take your money and they have to buy another type of asset to make sure they can pay you the interest on your savings here. What they put their money into is all these debts and all these things. The bank's assets went bad, and that's when the runs of the banks start. People want their savings back. And that's where we're in serious, serious trouble right now. And then when you talk about Orwellian, George Orwell wrote 1984. And what 1984 is, Big Brother is watching. And the big concern with Fed now, or Fed coin, Central Bank Digital Currency, CBDC, is that we lose our privacy. That they'll track us. They'll track every move because they'll know everything we're spending money on, what we spend it on, who we give it to, and all this. So it becomes George Orwell's 1984. Big Brother will watch you via our money.
That's one of many problems, Robert.
People like me panic. I said, oh my God, they're going to track me. I don't want them to know what I'm spending my money. It's none of their business. But now with blockchain and all this, they can track anything they want. So our privacy goes, and that's why it's when George Gammon says Orwellian, he's talking about 1984, Big Brother's going to watch you.
People often, in a crisis situation, are willing to sacrifice their freedom or the perception of safety and security.
A perception. of freedom and security.
That's a very important word.
People are finally waking up to the banksters. What bank is safe right now? And we have things like the FDIC, Federal Deposit Insurance Corporation, that's supposed to protect you up to $250,000. So if you have $250,000 of your savings, supposedly the FDIC will protect you. But what happened was it was in the billions over here. And that's when Jerome Powell, the Fed, and the FDIC got together and said, we have to bail these guys out.
Yep.
And that's called the moral hazard there. The moral hazard is that's the end of capitalism. How do you bail out the rich? But this whole thing is, the scientific term is one big effing mess. Trust has gone out.
But that's the opportunity for the central planners and the authoritarians, Robert. You have this banking crisis.
When George central planners, he's talking about Marxism, central bank. And that's what, our founding fathers, that was Thomas Jefferson. He says, we got to stay away from that one. Because if we go to a central bank, he said, our children will wake up homeless. And look at homelessness today is going through the roof. This stuff has been going on since the 1700s. And it's what George is talking about is now happening now. And everybody can sort of see it. And that's why the FDIC are panicking, because if you have like $250,000, let's say you have $1 million, does that mean you only get $250,000 back if you lose everything? Or is the FDIC, the Federal Deposit Insurance Corporation, going to bail out your $1 million too? And that's the uncertainty, because money is confidence, and our confidence is gone today.
Yeah, very well said. And I'd like to point out that the FDIC, they don't have that much. At the most, 200 billion, probably a lot less now. But let's keep in mind that there's roughly $18 trillion in deposits in the United States. That math doesn't work when FDIC only has 200 billion.
The Eurodollar means European dollar. It's dollars outside of America, which are then creating more money outside of America. There's trillions of euro dollars as well as US dollars. This thing's a big mess. It's like the big house of cards that's set to come down.
And that's my concern, that the central planners, the Marxists, are going to leverage that crisis situation. Their motto is you never let a good crisis go to waste.
Correct.
If we continue to see problems in the banking system that exceed the FDIC's ability to patch up the holes, then, of course, they come in on their white horse saying, well, we've got the solution. All you have to do is take your dollars from these unsafe commercial banks and just move them to the safest bank in the world, which is the Federal Reserve, which is the central bank. And people see that as, that little bit, that perceived security and safety, they give up their freedom. But what they don't realize is they're doing a deal with the devil.
I went to military school. We don't say it so politely. It says it's time to bend over and pick up the soap. Yeah. You don't know where it's going to come from anymore.
Right.
Because the cash is trash right now. In Rich Dad Poor Dad, it says savers or losers. The rich don't work for money and all these things. And we had this big 3-day here in Scottsdale. And we were talking about how the entrepreneurs like me, I stay out of paper. Anything that's printed. Took a company public. I own the paper. The IPO produces the shares, but I own the shares. I don't want to buy somebody else's shares with somebody else's company, because that's what another term is called counterparty risk. It's in control of somebody else, not me. It kind of bugs me. We're heading into it right now. It's not tomorrow. It's not maybe. It's right now.
I used the example of a tsunami.
Yeah.
I think that paints a perfect mental picture for people, because we know that a tsunami, when it's way out at sea, although you have this powerful force that's coming at land at 100, 200 miles per hour, you can't see it. They could go right under a boat and they wouldn't even know. But what happens there are these detection buoys that advanced countries have. They're 100 miles out off of shore, let's just say. And that detection buoy can feel, or it can sense that force coming toward the shore. And so then it sends a signal up to a satellite, and that satellite signals the scientists that are on the shore to go ahead and warn the general public. They don't know exactly when it's going to hit. They don't know where it's going to hit or how it's going to play out, but they just know this thing is headed at you at 100 miles per hour. That is basically what the yield curve does for us.
Okay, so what we're saying, ladies and gentlemen, it's here. The crack in the foundation is now showing. Crack is shown in how fake this whole system is, this whole monetary system that just creates money out of nothing. And when America started paying its bills just by creating money out of nothing, it's going to come back. And right now, the BRICS nations, Brazil, Russia, India, China, South Africa, Saudi Arabia, Mexico, Japan, possibly in New Zealand and Australia, the American empire is going down. And that means the dollar is possibly going down. We're here right now. All these real estate investment trusts, it's just foolish to me. I won't touch that stuff because it's all fake. So you save money and you put it in the bank. Your money is your asset, but it becomes the bank's liability. And what happened was when the banks have to buy something, the banksters, they have to buy something to cover the interest they're paying you here. And so they bought all these T-bills and this and that and all this crap. And then all of a sudden people realized the bank couldn't cover it all. And that's when the savers start running back to the bank, give me my savings back. And that was what the FDIC, Federal Deposit Insurance Corporation, was for, to make sure that they would give you money back. But these banks had created so many fake assets out here, they couldn't cover it. And so that's when Janet Yellen, who's the head of the Treasury, also she used to be head of the Fed. And the Fed says, we'll guarantee all these loans. In other words, the Federal Reserve Bank, which is not really a bank, and the U.S. Treasury says, we'll back up anybody right now. A crack in the foundation has been seen, and they're trying to fill that crack up. It's a really frightening time, but the average person is completely clueless because they can't see this.
What we can see is the 2-year Treasury yield is higher than the 10-year. So just right off the bat, if I ask you, Robert, if you're going to lend someone money for 30 years, are you going to charge them a higher or lower interest rate than if you lend them money for 3 weeks? Well, the answer is going to be a lot higher interest rate because there's a lot more risk.
For a longer term.
That's right. So when we see the short-term interest rates higher than the long-term interest rates, that's the economic tsunami warning signal saying, hey, something is really, really wrong. And most likely, we're going to have a significant recession or depression in the near future. Now, what does that mean? How do you time this? Well, what we've seen going all the way back to 1950.
It's already hit. That was Silicon Valley Bank and Deutsche Bank and Credit Suisse. It's already hit.
Yeah, this is just the first cracks that you see in the system, but the dam hasn't yet broken. And so that's what the yield curve is telling us. So when the dam breaks, how do we time that? How do we know when that's going to happen, assuming that Silicon Valley Bank is just the first crack?
Suisse went down, Deutsche Bank, and the Bank of Japan's next. This is a global crash.
Yeah, you don't know which bank is next, but the whole global economy is very vulnerable. And this is what that yield curve is telling us. So what people really need to be cognizant of is when the 2-year yield goes back down below the 10-year, because when the yield curve is no longer inverted, that's when we usually get the recession or economic depression. So right now, what the smart money is telling us through that curve is that we're most likely going to have that.
Yeah, this is historically. People say, oh, good, the 2-year went down below the 10-year. And everybody thinks that's good news. But that's the re-inversion and all this stuff, but it's not good news for the average person.
That means that the tsunami is not 100 miles away. That means that the tsunami is 100 feet away.
I went to school to be a merchant seaman, so I traveled the oceans. And these swells don't bother the ship. I went through several tsunamis and all this stuff at sea over the years I was out there. It didn't bother the ship, but when it hit land, boom.
So now, as prudent investors, or just the average Joe and Jane trying to protect your financial security, you need to ask yourself, okay, what is the financial tsunami warning system telling me, or what other signals or warning red flags can I extract from it? Well, the next thing that you need to look for is the curve no longer being inverted, which would mean the 2-year Treasury yield going back down below the 10-year. Because if you go back to 1950, you see that 9 times out of 10, that tsunami, that financial economic tsunami, hits the shore after the curve is no longer inverted. That's what people really need to focus on now.
So let me ask this question. When somebody says the Fed pivots, does that have anything to do with the inversions and all this other stuff? Or what is
Absolutely it does. Right now, the Fed is in a tightening cycle. They're raising interest rates. The Fed pivot refers to when the Fed starts actually lowering rates. And so usually when you see the curve, we'll call it uninvert, if that's a word, it's a result of the Fed actually dropping rates and dropping rates very, very quickly.
People will celebrate, says, oh, the inflation's over, everything's happy days are here again. Is that what you're saying?
You nailed it. And then the Fed's going to drop rates. Then they're going to say to themselves, oh, this is fantastic. The Fed came in, they saved the day. They're dropping rates back down to 0. We got nothing to worry about. If we were going to have a recession, now we're not. And then that's when that wave is going to impact the shore. And for those people who aren't prepared, that's when they're going to get financially destroyed.
Just wipes them out. And at sea, it doesn't bother you. It's just this big swell. But when it hits the shore, it just destroys it. It's hitting us now.
And there's just so many incredible parallels. How many people in the mainstream media are saying, oh, don't even worry about, don't focus on it. The unemployment rate is low. Economy's on fire. Everything's fine. And it's just like those people that are in Hilo that aren't paying attention to the warning system saying, oh, Robert, you're just fear mongering. You're sitting there talking about a tsunami that's never going to hit. We're protected here until the thing actually hits and they get wiped out.
Yeah, can I tell you something more silly about that? Before the wave hits Hilo, it has to suck all the water out of the bay.
Yeah, right.
And what happens then, Sarah, all these fish are jumping around because all the water's gone. And all the yo-yos go running out to catch the fish. And then the wave hits them, tears everything apart, people die. Why would somebody go there? You can go to the store and buy some fish, but just free fish. And that's what George is saying. When the Fed pivots, everybody can say, oh, happy days are here again. And they're going to jump into the thing.
It reminds me of the quote you say, when the tide goes out, you can see who's swimming naked.
Exactly. Don't go chasing the free fish.
Robert hit the nail on the head. That's another great analogy and parallel. When you're talking about that water going out and that people think that's free fish, that's the Fed dropping rates. Because when the Fed drops rates, most likely people are going to be, oh, great, that's free fish. I'm going to go buy stocks. I'm going to buy all these risk assets and get rich.
Yeah, they'll buy more real estate because the interest rates are down.
Exactly.
And they're going to rush back in and the free fish is going to kill them. So, George, how would somebody prepare for all this right now? I mean, what advice would you have for people right now? How do you prepare for this giant tsunami? I think it's the biggest in the world because it's global. It doesn't get much bigger than that, and China's having trouble too.
I think we've only hit the tip of the iceberg, and the reason I'm saying we've only hit the tip of the iceberg because after all these entities were bailed out, the yield curve is still sending us the exact same message, saying, hey, you guys think the Fed solved the problem, but they didn't even understand the problem. So getting back to your original question, though, I can just tell people what I'm doing with my personal portfolio. And I'm not all in cash, but I have the biggest cash position that I've ever had. And I make sure that I've got, 10% gold, physical gold. With the cash position, I'm currently in short term. It's very, very key. Short-term treasuries. Just 1 month, 3 month, very short-term treasuries, because those are a liability of the government. They're not a liability of a bank. And if you're worried about the banking system, that's that counterparty risk that I'm trying to avoid.
It's like if you have a brother-in-law that's a flake and he's always broke, wants to borrow $100,000 and you lend him $100,000, the counterparty risk is your brother-in-law is a fake. And that whole system is built upon. You don't know who's real and who's fake out there, who's strong. I'd rather just hold in my own hot little hands than lend it out right now.
Yeah, that's a great point. And the key here for people to understand, and the good news is that for those who are paying attention, we have this warning system. And so they can just go ahead and take the advice. They can head for the hills. And then, after it hits, they can be in a good position to go back to the town and buy a lot of that oceanfront property, that real estate, at a very, very low price.
Well, don't chase the fish.
Or just don't chase the fish. Make sure you're up in the hills. That's right. So that's what I'm doing in my portfolio. It's not all in cash, but I have the largest cash position in T-bills and gold. And I'm just waiting for the Fed to start dropping rates, not so I can buy, but I know that that's really when I need to get ready with my watch list, because I'm going to try to do my best to take advantage of the opportunity that this crisis will present. And the good news is that the larger the crisis, the larger the opportunity.
There's one more thing I want to say. There was the Banda Aceh in Indonesia, that biggest tsunami hit out there. The thing that was funny was that the humans were running out to catch the fish and the animals in town were heading for the hills.
Yeah.
I thought, I study all this stuff. I shouldn't laugh, but it's a human comedy. And the reason I say that is what people do in the investment world. They wait for something to be expensive. Oh, the price of gold is going up. Always wait a little bit. It goes up and up and up. Well, the price of real estate is going up. But they wait until the price is high and then they jump in. I hear, should I jump in now? I said, no, you should have been jumped in a long time ago.
Yeah, they usually wait till the exact wrong time.
At the
worst time to buy. Yeah.
Surfing all the time, they wait until the wave is breaking, then they take off and they get crushed. It happens all the time. So I own Bitcoin, but I waited for it to get to 20,000 and went down to 1,000, 3,000. And I watched it, wanted to make sure it was going to hang around. So I picked up 60 Bitcoin at 6,000. And, but I want it to be low. And the average person waits till it's high. That's the difference. That's when I talk about the metaphor of the humans running down to the water to catch the free fish. Meanwhile, the animals were heading for the hills.
Yeah.
So right now, I'd be heading for the hills. I wouldn't be heading for the free fish.
Exactly. And that's what the bond market is telling you to do.
If you understand history, the reason I pay no taxes is because I borrow money. I'm a debtor. And check this out. I mean, all you communists out there, check this stuff out. I am a billionaire in debt. You know why? Because I get tax breaks for borrowing money. And the reason I am so rich is because I'm in debt. And my friend Dave Ramsey says, live debt free. Well, you're an idiot. I mean, he's my friend, but I say, Dave, I like debt. He says, I know, but most people can't handle debt. I said, I agree. But that's why there's no financial education in schools, because if you knew how to handle debt, you wouldn't save that crappy dollar you have in your hand. I'd rather borrow the money tax-free.